Your wealth deserves stability, expertise, security. Your wealth deserves LGT Cresto, private wealth with over a century of global heritage.
And welcome to the Global View on this Thursday. I'm Andrew Gagan. Good to have you with us. So let's check in what's happening at a macro level, all about the Fed overnight, raising interest rates by 0.25 percentage point as expected, while flagging the possibility of future rate hikes, citing elevated inflation.
I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We think we need to stay on task. And we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
So the rate hike is the Fed's 11th in the past 12 meetings and takes the benchmark overnight interest rate to between 5.25% and 5.5%. That's its highest level since 2007. And Fed Chair Jerome Powell saying he's still holding out hope the economy can achieve a soft landing where inflation falls, unemployment remains relatively low, and a recession is avoided. And he noted that the Fed staff economists are no longer predicting a recession as they have at recent meetings.
In my view, consistently, that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours.
And as for the prospect of rate cuts,
be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
Well, US interest rate futures saw an increased probability of another interest rate increase by the Fed this year, with futures expecting the overnight rate to stay above 5% until 2024. However, US Treasury yields did slip in choppy trade after the Fed decision, with a 2-year just below 4.85% and the 10-year yield at 3.87%. The US dollar fell against most major currencies. The Aussie dollar, little changed at 67.6 US cents, having fallen yesterday on the release of weaker than expected inflation. All right, well, let's take a view of particularly the small cap end of the investment universe, globally at least. Greg Dean is joining us from Langdon Equity Partners out of Toronto. Greg, good to catch up with you again. Interested to get, first off, before we get into perhaps what we're seeing at an equity level, your reaction to that latest move by the Fed, which, as I said, was expected. Are those macro moves influencing your investment decisions at the moment?
The short answer, and thank you for having me back. The short answer is no. And thank goodness, because although people are calling the incremental hikes, nobody is calling them with enough foresight to make very much money at calling these hikes. I think every single release has been the last hike for the last 6 months. And here we are 4 hikes later. So,
all right, so Greg, give us an idea then of what is influencing your investment decisions at the moment.
It's very opportunistic, very bottoms up. So what the backdrop of this tightening cycle is providing is lower entry prices for great companies. I think we've kind of, the investment world had been conditioned to think that, 3, 4, 5% cost of debt was reasonable, and that put cost of equity at 5, 6, 7, 8%, which on a long-term historical basis is an anomaly. So we saw a valuation get ahead of itself, and then obviously late last year, things started to tighten and markets corrected. Arguably, they overcorrected, and I think so far this year we've seen a bit of a recovery from what was worried, maybe greater worries than have manifested. The default rates have not picked up materially. Unemployment is still manageable in most developed countries, and obviously Europe did not have an energy crisis. So the stuff that we care about are things within companies' control. But we do enjoy putting money to work amidst a backdrop that looks quite dire.
So you mentioned that opportunity to invest in great companies. What makes a great company then? What have you, for instance, added recently, perhaps, to your funds?
Well, I can tell you, it's not the types of companies that are blaming the macro right now. We have 6 to 12 months ago, it was fair to say, we did not see this coming. It's not really an excuse that we're letting many companies get away with today. And so what we're more interested in is what are you doing about it? So if you've seen input cost pressure or the inability to pass on price because the consumer is a bit more stressed than they were a year ago, and so you're having to see your margins contract. If you're a retailer like Thule, a business that we own, but the interesting thing about stock markets is they're very forward looking. They don't really care about what's happening right now. They're always sort of 6 to 12 months out, and then the bond market is maybe 12 to 24 months out. So the most recent company that we've put into the portfolio is a business called Watches of Switzerland, which is based in the UK, and they're the largest Rolex agency owner in the UK. They have about 40% of all Rolex dealers in the UK, and roughly 6%, 5-6% of Rolex dealers in the US. Incredible business. They've got long-term, 100-plus-year relationships with all the brands you can think of in the luxury watch segment, and they build stores, some multi-brand stores and some single-brand stores, and they're, you know, uh, obviously suffering from sort of lapping incredible revenue growth and margin expansion during what we would call the free money era, when people were at home and didn't have much to do. So a lot of them speculated on luxury watches, and we've seen a return to normalcy there. But the multiple, in our opinion, has come down way too much, and so we think that business at a low teens earnings and free cash flow multiple is extremely attractive. The business has top and bottom line growth north of 10%, which is something that's important to us, and the leverage is really manageable. And I think the value they add to these luxury brands would be very, very hard to replicate if you were a competitor tomorrow. And most of those agencies are also not for sale. So Warren Buffett owns a competitor. There's a Swiss family, Bucherer, that owns a competitor, and it's really three companies that control all the Rolex agencies in the US. So it's a fantastic end market and a great management team that's been in place for over a decade.
So, Greg, are you seeing continued momentum there for spending in the luxury end of consumer discretionary sector then? Because we have seen the likes, particularly in Europe, such as LVMH and so on, have obviously gone from strength to strength.
Yeah, and you know what? We love these companies that even when times aren't great, they do fine. And then obviously when times are good, they participate. We tend we've told our clients now for many, many years that we'll do our best work, and our companies do their best work in stressed and difficult end markets or stock markets. So, because not everybody is walking into a Rolex today and dropping $30,000 on a Daytona. Some of the competitors of Watches of Switzerland, who are not as well capitalized or maybe don't have the buying scale that they do, are unable to earn a reasonable wage or salary if they're a single store operator. And in many cases, they're being forced to close because labor rates have gone up. There's no longer people queuing outside the store. The demand just isn't as strong as it was a year ago. And so, if Watches is able to buy some of these franchises at in the current environment, they're going to be at much more attractive prices than they would have been 2 years ago. So we think that there's an opportunity for them to be more active in M&A, and all the while, like you said, I don't think the consumer is as bad as the stock chart would make you think.
Greg, we've seen the excitement that AI has generated among the mega caps. Are you seeing opportunity at the small end with perhaps companies that leverage to AI?
Yeah, so AI is actually one of these banned terms in the office right now, where if a company, instead of telling you what they do, if they just say, reference AI too many times, will tend to cut the meeting short. Because I think what it does is it atrophies the ability to understand a business. And so we own a lot of companies that I think are probably going to get hurt by AI, and we own a lot of companies that are going to get probably significantly rewarded by AI. But in aggregate, we're not exactly sure how things will play out. I think there's been similar to what happens with, when cryptocurrency or blockchain technology is sort of the soup of the day. It gets a lot of people whipped up and enthusiastic and excited, and we think the world is going to change tomorrow. It often takes a lot longer to play out. I'm not sure that the blockchain technology has actually disrupted anything yet of major consequence. It is going to, I'm sure, at some point, but these things play out much slower than expected, typically, and usually the capital arrives very quickly. And so, some of the businesses that we own that we think could be at risk would be some professional service firms, some people are even saying, money managers. There's a lot of stuff that we're going to be able to harness here within Langdon that we think is better suited for, a machine learning algorithm than it is for a human to handle. And so some of those, tasks are perhaps best handled through automation, and it will force everybody else here to spend more of their time on higher value tasks. And I think the flip side of that is some of the businesses that are going to be able to harness automation are going to be able to improve productivity. But we're not a thematic investor, and we don't really start with the problem and then look for solutions, or even worse, sometimes people start with a solution and then go looking for problems that it can solve. It kind of feels like that's where AI is today.
Well, we are out of time, but I'd love to explore that further with you, Greg, at another time. Thanks so much for joining us from Langdon Equity Partners.
Thank you.
All right, that is the Global View for this Thursday. Stay with us. The Open is just around the corner, where we are expecting a flat beginning. Stay with us.